What considerations are involved in a corporate stock acquisition? Well, usually you're talking about a stock acquisition whenever you're purchasing a business. There's two ways to buy a business: as you buy the assets, the goodwill, the accounts receivable, the use of the name, and maybe restrictive covenants. And if so, that's an asset purchase, and you do not buy the stock, and that's the way most businesses are sold. The reason for that is that the buyer does not want to get hit with any unknown liabilities of the business. So to answer the question, the consideration as far as taking the stock rather than just buying the assets of the business is that you are responsible for all liabilities that you may or may not know of. Also, as far as any tax liabilities, sometimes that has to do with if there's subchapter S's where you can allocate the stock. Also, another tax consideration is you do not get a increase or a stepped up in basis in the assets. If you buy the stock, you wind up with the assets as far as being depreciated. Now, that's looking at it from the buyer's perspective. From a seller's perspective, it works very well to simply sell the stock, and that way it's very easy. You simply transfer the stock, roll the stock certificate over and hand it over to the buyer, and the buyer turns around and gives you a check or gives you the proceeds. Usually with a contract, though, there's a lot of due diligence to try and determine if there are any liabilities and as far in any taxes that are owed. Usually a stock acquisition happens whenever you have one shareholder is buying out another shareholder, and it's not a complete sale, but they're already involved in the business, and you're buying out the retiring partner or a partner that wants to leave, or under a buyout arrangement that you entered into previously. If we have an unhappy a shareholder, you're not getting along in a small business where everyone works in the business and someone's leaving, then they can simply buy his stock out since they already know all the liabilities and the tax considerations. So that's the considerations you have as far as how to structure a purchase of a business. If you're buying from a stranger and buying all the assets, I suggest you do an asset purchase rather than purchasing the stock. Whereas if you're involved in a corporation or an LLC and you're buying out your partner, well, then the purchase of the stock is the way to handle that buyout. So if you have any questions, well, give me a call at 727-847-2288.